Good afternoon and welcome to our next charitable giving webinar. Thank you for joining us. As always, feel free to ask questions either in the chat or in the Q&A. My name is Michael Horn and I'll pass it over to everyone else.
Hey, my name is Daniel Milms. Glad to be here.
And my name is Scott. Last name is Vigneri or anything close. And I see that Daniel has a guest with him that he did not introduce.
That's one of my cats, Ziggy, which he just dropped down.
Ziggy?
Ziggy.
Ziggy, okay. So I was just at my family's and the topic of cats came up several times. So that's why I kind of noted it. And we had a cat named Charlie that was my daughter's that is now in California with my daughter. But at any rate, hope everybody had a great Thanksgiving.
Yes.
And we wanted to stay on task and be as consistent as possible, even through these holidays, and offer you the webinars. And these are recorded so you can come back and view them at a different time. And I wasn't going to spend a whole lot of time on Index Universal Life. In fact, I wasn't even going to talk about it, but I thought maybe I better talk about it because it's become a bit of a trend and kind of popular. So somebody out there is going to have questions about it. So I thought I'd address some of those questions a little bit. So we are going to talk about IUL. This is a missions-based presentation. We're talking about charitable giving for missions, but anybody is welcome. We will be talking about the Bible and the gospel and Jesus. In fact, we are going to start out with a word of prayer. But again, maybe that's not your philosophy, but you're welcome to stay. And we would love to have you. So let's pray. Father, thank you for your mercy and your grace. Thank you for this opportunity. Pray that you bless it now and help us to help the gospel now. In Jesus' name, amen.
Amen.
All right. Dr. Mike, if you could go ahead and get us started. This is going to be a rather short slides.
All right, it's coming up now. Yeah, I've heard of whole life before, but I hadn't heard of Index Universal Life. So it's definitely a new one for me.
And like I say, this photo of this young lady always grabs my heart because what's going through her head there? And it looks like she's apprehensive about something, maybe having her picture taken, or maybe having a photographer there, or just all these other people that might be there at this time. But God knows her heart, and God loves her, and God created her, and God knows everything about her. And these people and many children around the world and many of their parents around the world need to hear the gospel. And so that's what this is all about. It's not about life insurance. It's not about, financial. It's about helping to get the gospel out. This is learning about the best tools that are available to you, not what some financial advisor thinks is best, but it's what works best for you. So we're going to talk about Index Universal Life. Kind of a mouthful, isn't it? So let's go with the next slide. Today, we're going to take a brief look at Index Universal Life, and we have talked primarily about whole life, but I want to take some time and look at Index Universal Life, or IUL. It has, as I mentioned a bit ago, that become fairly popular in the past several years, but why? Well, probably the biggest reason is because of perceived potential. So let's open the door and take a look.
I like the sound effects.
No charge.
You need like a transition thing or something.
There you go. Yeah. The first thing about an Index Universal Life is exactly that, indexed. What does that mean? The growth inside the policy in your account, your cash value account, is built around an index, such as the S&P 500. Now, many carriers are utilizing other indexes as well, but the S&P 500 is probably one of the most familiar to everybody, and many policies are using some form of the S&P 500. Almost everybody has that to do one degree or another as an option. Most policies will have several different options, and you can use several different indexes. And you don't have to choose just one of the indexes. You can use the S&P 500, and then you can use a bond index, do a 70-30 or whatever you want. You sit down with your agent or your financial advisor, and they can help you with that. So with a whole life policy, the carrier gives you the declared rate, and that is what the basic account earns. And we're not talking about adding in the dividends or paid up additions and anything else like that. So if on a whole life policy, if the carrier says your rate is going to be 3%, you're going to get 3%. And that's guaranteed. And you're like, 3%, that's nothing to get excited about. No, it's not. But the other side of that is that it's guaranteed. And just briefly aside, let's talk about the tortoise and the hare. Who won the race? The tortoise. So on the one hand, 3% pales in comparison to somebody who's getting 7, 8, 12% somewhere else. But they got it this week. But next week they might get -12. You never know. But this is something consistent. And with an IUL, the earnings are benchmarked by the index, like I said, the S&P 500. Now, what a lot of people don't understand is that the money is not, your money in that policy is not in the stock market. The carrier is using that index as a benchmark. Your money is not in the S&P 500. It's not in the Dow. It's not in any of those indexes. They're using those indexes as a benchmark. They are investing in different things like treasuries. They're investing in some cases, options. They're investing in mortgage-backed securities. Much of it is very, very safe stuff. And you might think, well, options, that doesn't sound. When you have the experience and the know-how, and that's all you do every day of your life is invest in options, it's not as risky as it might seem. And it's not like they're going to try to make a huge, 400% gain. They're not looking for that kind of stuff. They're just looking for a little bit here and there. They're not trying to make or break the bank in one trade. And yes, they only use a portion of it. So your funds are not in the market. All policies have a floor, which means you will never lose any money in the market. But the gain is not guaranteed because it is benchmarked to that market. So let's go on to the next page. Go into a little more detail there. I went ahead and left this slide in. I probably should have changed the order of it, but we enjoy the same tax benefits with Index Universal Life because they're both life insurance. Many of the tax benefits of whole life are available in IUL as well because they're both life insurance products. The tax code is for life insurance. It would work for term if you build up a cash value in term, but they still use the guideline premium test and they still use the cash value test. And then we got to be careful about endowment contracts or MECs and so on and so forth. But the lump sum death benefit always maintains its tax benefits. There are rare cases where you can forfeit that, but in most cases, the carrier will say, hey, wait a minute, you need to be careful. It is a little more risky with an IUL than it is with a whole life policy, because we're going to get into that here in a minute. All right, next page. There is a floor, but there are also caps. I got to move. Our little panel here that has all three of us is covering up my text.
That makes it difficult.
Yeah. So there's a floor, as we said, where you cannot lose money, and you will not lose any money because of the market. And everything you gain, once the period is over, you will never lose what you gained. So let's say year one, and most of them are 1 year periods. So let's say in year one, you earned, let's say 10%. Let's be nice. So you earn 10%, and the next year the market goes down and there's a loss. Well, you get 0%. Wait, I didn't earn anything? No, you did not. But you didn't lose anything either. You didn't lose that gain, and you didn't lose what you put in there. But you didn't make anything either. Now let's step outside and go into a security product like a bond or a mutual fund or an ETF. We lost part of what we gained and maybe even some of the principal, depending on what the loss was. We did lose there. Here, you're not losing anything. So there is that. So there are caps and there are participation rates. And in this case, if the cap is 10% and the benchmark returns 8%, then the account gets 8%. But there's a catch to that. We'll get to that in just a second. But on the other hand, if the benchmark earns 12% and we have a 10% cap, the account still only earns 10% because of the cap. Then along with the cap, there's what they call participation rate. That determines how much of that benchmark returns gets credited to the account. If you have a 100% participation rate, then you get the full 10% if it earned 10%. But if it was at 8% and it was a smaller participation rate, you would get less of that as well. So let's say if there's a 100% participation rate from the full 10% gets credited, but if it's 75% participation, then that 10% gets down to 7.5%. That's what will be credited. So the cap and the participation rates can be changed by the carrier. And if they do, it's because of market conditions and interest rates. So there are moving parts to an IUL. And that's one reason that many people are afraid and even, decry, stay away from IULs. So they can be changed. Why would they do that? First of all, they need to maintain their costs. And you can't get into a position where your costs are over what you're making. So they have to be able to pay all the costs. Well, what kind of a cost does an insurance company have? Well, if somebody dies, they have to pay that policy. And if we have too many people die, then what the actuaries figured on, that has to come out of the profits. But on the other hand, if not enough, that sounds horrible to say, not enough people die. Come on, people.
Actuaries.
Yes. If less people pass away than what they expected, then there is some profit, and that will go into dividends, but that's a different topic altogether. All right, on to the next page.
A quick question.
Yes.
What is the point of the participation rate? Like, why would you have a lower participation rate?
Because it will help in other areas. It helps reduce costs, and it depends on what index you're in. And if you're in one index, because the carriers have to pay for that index, to use that index. A lot of people don't realize that. The carriers have to pay for a lot of different things, and there's a lot of moving parts. They have to pay for options contracts. They have to pay to buy mortgage securities. Excuse me. And they have to pay. And so it can be expensive.
I got you.
They set the participation rate, but you get to choose which account you go into.
Okay.
Now, if you want 100% participation, then you probably get a reduced cap. But if you want reduced participation, you get a higher cap. That's usually what the trade-off is.
I see.
So it is important to sit down with an agent that can help you, that understands how that works and what you are trying to accomplish. All right, let's move on to the next page. Now we're on the wrong side again.
That's what I got next.
All right, why would someone want an IUL? There may be people out there right now that are thinking there's too many moving parts. There's, it's not guaranteed that I'm going to make this amount. There's costs, but yet the trend is that more and more of these are being sold. There's a lot of people buying these policies, and huge policies, as I mentioned before. In our industry, where we work with people of higher net worth and ultra high net worth. And they're buying policies of 50 million, 100 million, 10 million. They're buying big policies. And then in some cases, they're using premium finance to do that. Why? Because of the potential. That is the bottom line. You have a potential greater gain with an IUL than you do with a whole life policy. But on the other hand, people like the solid guarantees that come with a whole life policy. The only thing not really guaranteed in a whole life policy is the dividend rate, because they don't know from year to year exactly what profits are going to be. And that goes back to what I said earlier. If they have more losses, they have more costs. If they have less losses, then there's a little more profit. And that is reflected in the dividends. So there's more potential to gain than with a whole life policy. But you have most of the same tax benefits. Now, what I didn't talk about is that it's built on what they call universal life, which is a universal chassis. And a universal life, you don't have the index, but universal life came out, what was it, the 80s, I think it was, or maybe the 90s, no, the 80s. And it offered flexibility. If you couldn't or didn't want to make a payment for whatever reason, you had the option of foregoing a premium. If you have a whole life policy, to keep it alive, you need to make your premium payment every month or every year, however you set it up. If you miss, it will start eating into your cash value. And that can happen with the universal, but there is more flexibility. There is no flexibility with a whole life. You need to make that premium payment each month. That's one of the main things about universal that a lot of people like. You can also have flexibility in the amount that you pay. So it all depends on how much is built up in the policy as well, and what kind of premium you set up. Did you just do what they call target, which is just enough to cover the cost, or did you set up a premium that overfunds the policy? What are some of the drawbacks? One of the drawbacks is illustrated rates. Many times an agent will sit down and they'll come in with an illustration, and it's a ledger, and it's got all these numbers, and they got usually 10 pages or more. And it's they have all the definitions of everything used there. And then they go through all the numbers. And they say, this interest rate is guaranteed, this da-da-da-da-da. And then they have the illustrated rate. And sometimes to be competitive, they will use a rate that may not be realistic, so they can get the competitive advantage. Now, agents out there are shaking their heads at me, and they're, going to string me up after this.
Never do this.
Yeah, but not every agent is like that. And it really, there's companies out there, or there's carriers out there that they can show a very good return. But 10 years down the road, because of costs, it doesn't hold up. So it's not necessarily the best thing to look at the rate. You got to look at the whole package. And that's why I didn't do any charts here, because it's all subject to the market, and there's no way to tell that for sure. And there is, as I alluded to earlier, it can be possible to have a negative growth due to costs. So if you have several flat years and you're making zero, there's still a cost of insurance, and that has to come out. So you could find the account losing money because of costs. The likelihood is not, not really likely that that's going to happen. But and then the other side of that is growth is not guaranteed. Now, most likely you're going to get overall growth, but there's no guarantee that you're going to get the 7% that the S&P has earned over the past 70 years. Then we need to get into what they call a sequence of returns. So that's a whole different story. But a lot of that, when they say the S&P has averaged 7%, that doesn't mean you're going to get 7% every year, and you cannot bank on that. Especially the shorter your window of time is, the bigger a factor that's going to be. If you're depending on an income from someplace and you have a 10-year window, you're 70 years old and your life expectancy is 80, and you're 2 years in and the market tanks and you lose, that can be a major, major upheaval to your income. And that's something to consider. Now, a lot of these policies, a lot of other products have built-in guarantees, but there's an extra cost to that. But for some people, it's worth it. Some people, they don't want any of that. They love the potential and they think the market will carry them through. And there have been many people that have done very well relying on the market. But I think it's recommended to have some form, to some degree, of guaranteed income in retirement. You can use life insurance, you can use annuities, and you can use bank CDs if you want to do that, if you hate insurance. So I think that's the last slide.
Yeah, one quick question I got here is now with whole life from the previous talk, you can take out a loan on against your cash value. Is that possible with the IULs?
Yes, you can take out loans on IULs as well. Things are figured out a little differently, and this is where you need to be really careful. You need to work closely with your agent, and you need to monitor the performance of the policy to make sure that you're in a position where you can take loans, and you need to keep track of it. And because you can be in a position where the loan will tank and will implode your policy, and then happy days, you end up in a taxable situation.
Yeah.
So these are critical things to be aware of. And yes, I'm probably scaring a lot of people away from IUL. Good, because it's not for you then. But some people are like, okay, all right, I understand. We can do that. We can do that. Just as long as you're aware. And that's what all this is about, to help you understand how some of these things work and whether or not it works for you. You will find agents that absolutely hate whole life and love index universal life. That's part of the trend. It's not the people that want it, it's the agents trying to sell it. Then you will find agents who hate index universal life and love whole life. You will find people who hate permanent life insurance and think that you should buy term and invest the difference. The caveat to that is that very few people actually do that. And then we get back to sequence of returns. But that's a little off topic, but so.
And then one question I think you've answered, but just to verify, which is better, IUL or whole life?
Well, as I said, you'll find agents that hate whole life, and you'll find agents that hate index universal life. And the truth is, it's not up to the agent to decide what's right. It's up to you to decide what's right. The agent or the financial advisor is supposed to guide you and learn your situation well enough so he understands what you want. I sat down with a client right before Thanksgiving who does pretty well. And we presented some ideas for saving taxes. They were a little on the exotic side, but the tax benefits were huge. We could have saved this client $450,000 in taxes. But the client was like, no, I'm out. It's too complicated. I just like simple stuff. And the presenter's like, wait, $450,000 in taxes you're saving. And they paid $500,000. We could almost wipe out their entire tax bill.
Wow.
But it was too complicated for them. And now I realize this particular client, their goal is, how do I say it without being too specific? Well, they're in the real estate, and everything they want to do is in real estate. So this was not real estate focused. So I found some other things, real estate focused, that can help them. Cost segregation studies, and we can do opportunity zones, and we can do DSTs and 1031 exchanges, and those will help client tax wise. So it is not for me to tell the client what to do. It is for me to guide the client according to what they want to accomplish. The same thing with your agent or your financial advisor. Find somebody that's going to learn what you want and say, okay, let's find a way to do that, instead of this is what you need, this is what you need, and telling you what to do. Because everybody is different. And you need somebody who's going to sit down with you and take the time, instead of just trying to force some kind of product down your throat. Sorry, guys. I'm talking to all the agents out there. So
Well, you mentioned stuff like options, and I find options are fascinating, but they really make my head hurt. But
yes.
So this really, I guess, legally speaking, isn't an investment. This is insurance. So
Yes.
there's no capital gains if it pays out. Is that right? Unless you
No,
pull money early.
it grows. Everything in here grows tax free, and you are not investing in options. The
Mhm.
company is investing in options.
Gotcha.
Your money in both these cases is in the general account. Now, we could go to variable life, which is a little bit different animal. Then we are investing in the market through what they
Mhm.
call sub accounts. Outside of life insurance policy, they're mutual funds. And inside their sub accounts, because there's different management. It's legal and security laws dictate how we have to call them sub accounts. And so variable is a whole different ballgame. And then you are investing. And but there's also tax benefits to that as well.
So would you say like a typical IUL, the way you explained it, kind of reminds me of how I invest in my 403B. The money goes in there, and then I can set up, I want to have this percentage put into high risk, and this percentage of it I wanted to go into like a medium risk, and this percentage I wanted to go into a low risk. Is that sort of how these work, or is it just whatever the IUL is indexed?
As far as the company investing the funds, they decide how to invest them. As
Okay.
far as your money in your account, you can choose what index you want to. And you can also I think every carrier has a fixed rate. So let's say I want a guaranteed rate of, let's say it's 4% right now. So I put 30% into the guaranteed. So I know that 30% of my money is going to earn 4%. Then 70% I put into the other indexes. Let's say I put 30% into the S&P 500 index. And then I put 30% into the bond index. And then I get really exotic and I put it into the MSCI Latin America index, 10% into that. I think that adds up to 100%. So you have that option as far as that. But as far as how the money's invested in the market, the insurance company does all that. And they choose the options. They choose the mortgage-backed securities. They choose where it goes. But as far as the benchmark, you can choose the benchmark. And you can choose usually 4 to 5 benchmarks within your policy. And if you decide you don't like the performance, or you think the fixed rate is a little too weak and you'd like to take your chances on something more, you can change it. You can change it every year. Now, some of them have what they call point to point, which means it's from one date to the next. Most of them are 1 year point to point. So if I set up a policy on January 1st of 2024, the next point is January 1st, 2025. That's a 1 year point to point. And they'll take a picture at the beginning and at the end. What happens in between really doesn't matter. That's not quite
that's why
good.
I usually don't check on my accounts very often.
Right. I mean, they do go from month to month, and there is some benefit to it. It all depends on the index and the product and the carrier. So let's say I'm in an S&P and it's at, let's throw out 10,000. And then the next year, a year later, it's up to 11,000. Well, then I'll get that benefit. And then that's set in stone. Whatever I made that year, I never lose, period. And then it goes from there. So it can grow, but you will never lose. But you do need to be aware of the costs.
Right. I was going to ask you about that because you touched on that. It seemed like whereas a whole life, you know, if there's any cost, it's baked into the package. But in this case, you know, if the investments, I guess, went really poorly that year,
Right.
you could actually lose some of the funds that you put in that year. Is that?
But not from market loss, only from costs. You will never lose any money because of market loss, because you have a 0% floor.
Mm-hmm.
There were some carriers that had a 1%, and then for a while there was even a 2% floor. Well, I think all carriers are now 0%.
So it could be that it was just an awful year, so you've hit the 0% floor. The company's lost money, but that's not your problem. But the fees that you pay, the management fees, would be, you know,
right,
quote unquote loss to you.
Right.
Granted, I'm guessing that the fees are probably, well, I guess they could be pretty big. I guess it depends on what you're putting in there.
Right. It depends on how you set it up. Also, it depends on where you're at in the policy life. Usually the first 6 to 9 years are where most of your costs are in a policy. The costs never go away, but they usually start reducing after about the 6th to 9th year, depending on the policy and the carrier. And that's true with pretty much any policy. They're
like a mortgage.
Yeah, they're kind of front loaded is not the proper term, but it's the right idea.
Sort of like if you take out you're offered a 0% loan, but it's loaded with initial fees and origination fees. So they're basically taking their money right now, today, instead of little by little.
Pretty much all of them are set up that way because they have to cover their costs. You know, insurance, every insurance policy, every insurance carrier has to submit every single policy and every single carrier to every state. And there are some states that do not approve certain policies. And Indiana, I live in Indiana, and Indiana has modified some policies that I sold in Illinois, and they don't have the same benefits to my people in Indiana that they had in Illinois, because Indiana went, no, we don't like this part, reduce this or increase this. And so they all have to be approved, and that doesn't mean each state endorses them, go, oh, this is good, you should buy this. No, it approves it for sale, but they're not endorsing it in any way, shape, or form. And so, you know, there's people out there that say the insurance companies are evil and they're out to take you for all your money. And no, it's not true. They're a business just like anybody else, and they're national. Most of them are nationwide, and they've been around for, man, Pacific Life has been around 140 years. Penn Mutual has been around 175 years. New York Life has been 100 and I think it's even been longer than Penn Mutual. And go on and on. That many of these companies have been over 100 years, and many of these companies were very necessary during the Depression and other situations.
I've always been the mindset that insurance is just a prudent thing to have. It's you know, I've seen what happens when somebody dies and they didn't have any insurance, and what a hardship that puts on their family, and
exactly,
it can be very, very rough. So I always looked at it as sort of like, personally, like this is the bare minimum that I can do just to make sure that it eases that transition, it eases the stress and the struggle that, you know, you have to go through.
And in some cases, you know, if it's financially a challenge, then term is the best way to go. It gives you more bang for the buck. And sometimes you may want a combination, a hybrid of term inside a whole life policy. Because the downside of term is that, let's say I buy a 20-year policy and it ends in 20 years, but in the meantime, I develop cancer. And now I can't qualify for any, or it's so expensive, I can't afford it.
Right.
But if I bought a whole life policy or some kind of permanent policy back at the same time, it's still being enforced. Doesn't matter if I catch cancer. It'll never end as long as I make the premium payments. So maybe a smaller permanent policy and use a term policy to make up the difference. And then when that runs out, and hopefully you've had the discipline to invest that some of that difference into a mutual fund or a ETF. You know, tech ETFs right now, I get ETF news almost every day. There was one tech fund that was earning 49% so far this year. Woohoo. But it could lose 49% tomorrow too.
Right, exactly. You just never know.
Exactly.
It's all over the place, it seems like.
It is. And then you have inflation and taxes.
Yeah.
And, you know, everybody looks at the paltry, what we consider paltry returns in a life insurance policy, but they don't take into account the tax benefits. You can take it out on a basis where you pay no taxes, but you have to do it correctly. And we talked about that, I think, last time, where you can take it out as a loan. And many people, well, that's my money. Well, no, it's not. Your money stays in the policy. The loan is your policy. Your money in the policy is collateral for the loan. And yes, there's interest. And if you don't want to do that, then you will pay taxes on the money you take out after your basis. If you put $100,000 in, but you take $125,000 out, you're going to pay taxes on $25,000. So you got to take that into consideration too. And what tax bracket are you in? Let's say I'm in a 27% tax bracket. And the loan rate is 4%. Well, I'm still ahead by 23%. Is that worth it? That's something you got to decide if that works for you. I talked about premium finance a little bit ago. Many higher net worth and ultra high net people buy policies for estate tax reasons, but they're not real excited about paying insurance premiums. Their money, you know, they have it in their business and they're making 13, 14, 15% or more. And now they got to take that money and put it to an insurance policy. So cost of capital is a big factor. And so what they'll do is they'll finance those premiums, and that can be done. Now, there's a lot of premium finance. I shouldn't open that can of worms, but premium finance is not for everybody, and it's only for higher net worth people. There are carriers out there, there are marketers out there that are presenting premium finance for small policies. Stay away from that, because so many of those explode, and we have collateral calls, and they're selling index universal life, and it doesn't perform, and yeah, and it's stuff like that gives things a bad name. But my point is that you got to look at your cost of capital. Is it better for you to put your money here and get the tax benefits, or is it better to put it over here? Only you can decide that. And you can sit down with an agent, like I said, that wants to help you accomplish what you want to accomplish, not what he's trying to sell or what he thinks is best. And many agents think IUL is the best thing since sliced bread. And there's other agents, like I've said, that think whole life is the only thing. I think it depends on the client, and you got to sit down and learn what the client wants. So, all right. Any other questions?
Looks like that is it at the moment.
All right. So thank you for being here today. Appreciate it. And like I said, the whole concept of what we're trying to accomplish here is get the gospel to the world.
Amen.
And what they're doing at Final Frontiers is just phenomenal. And I'm hearing stories all the time about how many people are getting saved and how many people have heard the gospel in very dark areas as far as the gospel goes. I read a story about the other day about a girl who was not in witchcraft, but she talked to demons and would make people do what she wanted them to do. She was only 12 or 13 years old. She heard the gospel. And the way she heard the gospel was those, I don't know what they're called, those little packs where they can show a presentation on a wall or something like that. And there was a missionary giving the gospel story about Jesus. And she saw that. And she wanted to get saved. And she got saved. And her grandmother wants to kill her because she got saved. And we have no idea what the rest of the world goes through. But because of that little film pack, what do you call those things? Projectors?
We have one that we sell. It's called the Power Pack. It's
Power
a
pack.
projector and a PA system and everything.
Yeah.
All in a pack.
Because of that power pack, this girl got saved. And what a tremendous story. And she's gone on and her life has changed and she's changing the lives of other people. It's a tremendous story. And that's what this is all about. To help it so that one day you have built up an account value in your policy. If you decide to take a policy, you can take out a loan or even just take out the money on a surrender if you got enough basis and pay for, buy 3, 4, 5 power packs or help one of these pastors to get a motorcycle or a scooter to get around. Because if they have a means of transportation, instead of 1 village a day, they can reach 10. There are pastors out there in these other countries that they live and breathe every day to reach more people. And they're very humbling. I think when we get to heaven and I stand next to one of those people, I'll be humbled. And, I have to put my hat in my hand. I'm going, there's a man greater than I am. And so what we're doing here is trying to give these people the tools so that they can reach the people. And like I said, that's what this is all about. You may be on here just to learn about charitable giving and about life insurance and IUL. And like I said, you're certainly welcome, but this is what we're all about. And we'd love, if you've never heard the gospel and you would like to learn more about the gospel, Daniel or Michael can connect you. There should be a phone number somewhere and you can reach out to them and they can put you in contact with somebody wherever you are in the world. But so Christmas is coming, and the whole reason Christmas is Jesus came to die on the cross because he loved us and he loves us and he loves you and he loves me too. But so anyhow, I'm getting off on a tangent here, but thank you for being here. And if there's no other questions, I guess we'll sign off.
Yes, thank you for joining us, everybody. Feel free, if you have any other questions, to shoot an email, and we'll see you towards the end of December. We'll have that posted probably in the next week or two for our next webinar, and we look forward to seeing you then.
Thanks, everybody.
So if you guys got a minute, I don't know if we call or are we already offline?
Not yet. Let me end.
Guess we'll have to edit that one.